Chris Wetherbee, the Citi's Transportation and Shipping Analyst. It's my pleasure to be here at Capital Links Forum here. And I'm joined, you can't hear? Is the microphone on? Probably not.
Do you have to press a button or no? No?
There's a button. Press right.
This one's on. Want to try
Okay, is that better?
Yeah.
Fantastic. I thought I was going to get away with nobody hearing me. That would be even better. Okay, well, again, I'm Chris Wetherbee, Citi's Transportation and Shipping Analyst. It's my pleasure to be at Capital Links Forum hosting the LPG panel. Today, we're very pleased to be joined by a number of guests. To my left is Christian Andersen, CEO of Avance Gas, Mr. Ted Young, CFO, Dorian LPG, and Miguel Potter, who's the CFO of EXMAR. I'm going to run through some questions on the industry. I have a couple of company-specific questions as well, and then I would certainly want to leave some time for the audience to get involved towards the end of our session. So I'm going to kind of jump right in here and kind of maybe lay the groundwork here with some more of the sort of basic drivers of the LPG market, and maybe we can start with Christian, because I like your name and you're just to my left here. So maybe you can help us let's talk a little bit about sort of the demand drivers of the LPG market and kind of where you see that right now.
Thank you very much. Well, LPG is, as I've been saying on several occasions, it's very different from any other commodity you come across, because no one has ever made a ton of LPG because they want LPG. They just get it because they either want crude oil or nat gas. So when we look at the product part of the LPG space, it's a supply-driven space. So all LPG is sold somewhere. Except for the US, all LPG in the world is put on a ship and sold overseas. US is a bit different because in US it's a huge domestic market as well. And the domestic market is much bigger than the export market. And up to 2013, no big ships were exporting LPG from the US. So the US export market is completely new, just some few years old. Demand for the LPG is globally 50% households, 50% industry. And the biggest industry is feedstock for petrochemical cracking. And over the last few years, PDH plants also making propylene. So when we are analyzing the LPG market, we are more looking at what is the supply rather than what is the demand. The LPG will be moved. The price will eventually find a level where it makes sense to put it on our ships and sail it far away to the Far East.
That's helpful, and that's a great point. So when we think about U.S. exports driving the volumes in the industry, how do we think about export capacity, how that might change over the course of the next year or so? Maybe I'll throw this over to you, Ted, if you could help us understand that dynamic a little bit better.
So we've seen, thanks, we have seen massive growth in U.S. export capacity. To put a few numbers around the historical context Christian just gave you, in 2012, the U.S. exported 4 million metric tons of LPG, which is about as much as it imported. This year, we're on track to do 22 to 25 million metric tons, and it's been pretty steady, 40–50% growth year over year in the intervening years. So the Phillips facility comes on shortly, and that's sort of the last major export facility that's going to be added. So we've seen a significant increase in export capacity. Christian may have his hand in the numbers better than I do, but I think we're probably approaching 40 million metric tons of export capacity in the U.S. now. Which is a substantial number. And over time, I'm sure we'll grow into that. As I said, right now we're somewhere in the 22 to 24 million metric ton range with a somewhat challenging commodity price backdrop because the arbitrage economics aren't as favorable as they had been. But I think it's pretty easy to see your way towards the export terminals getting back up to the 90+% capacity utilization levels in the not terribly distant future.
Okay. Can I just add one thing? I agree 100% in what you're saying. In 13, 14, and 15, the VLGC export capacity from the US was a bottleneck. That's history. It's not the bottleneck anymore, and we don't expect the terminal capacity to be a bottleneck in the future.
That's helpful, and I want to pick up on a point, Ted, that you made about the commodity price environment. Maybe, Miguel, I'll throw this over your way. You know, obviously some negative crude data points out this morning. We're seeing the energy markets under pressure again today. When we think about sort of the dynamic of energy prices on the crude and natural gas side and how that kind of impacts production and sort of maybe where we can feel like we're comfortable with not too low prices and production kind of in balance, is there some help you can give us in understanding that dynamic?
Well,
I said it'd be easy. I told you it'd be easy.
if I would understand fully that dynamic, I wouldn't be sitting here probably. Definitely the overall energy and commodity pricing has a direct impact on the LPG as a trading commodity. The LPG is mainly used, as my fellow competitors were saying, for a lot of it is used as a feedstock for petrochemical plants, for crackers. And there it's balanced against naphtha. So indeed, naphtha as a direct derived of crude oil product is currently being cheaper, and so some of the refineries around the world are thinking about switching back to naphtha again, which is definitely impacting our market. Although when you look at the LPG prices today, low LPG prices around the world are giving ship-owning companies and incentives and utility companies an incentive to actually ship the product even further. China was a non-existing market up to 5 to 6 years ago, and now a lot of product is being shipped to produce to the PhD plants in China just because of the low price of LPG worldwide. And in terms of ton miles demand, this is definitely improving the positions of ship owners. Unlike other shipping segments, we have to admit that in the LPG sector, we've been very comfortable making some gains over the last 10 years, even some years a lot of gains, but not really a lot of losses. So we're in a very steadily boring market, and we like to keep it that way.
Yes, agreed. Very helpful. Christian, I don't know if you want to comment a little bit on the market, commodity-wise.
Yeah, I'd like to just say a comment to the first part of your question. What about shale gas and tight oil in the US? And I just want to say that the most important production is the tight oil here in the US. Shale gas delivers very little LPG. If you look at tight oil and shale gas, tight oil delivers more than 80% of the LPG coming from shale structures. So going forward, the crude oil price is much more important than Henry Hub to get the sustainable production of LPG in the States.
Do you think, just following up on that, and Ted certainly feel to jump in, is a $40 crude number acceptable?
$40 crude will give us less LPG to export. We need the crude to be, let's say in the period up to 2020, we should see a crude oil price above 80, 90 in order to have enough crude oil production from tight oil to give us enough LPG to produce. So if crude stays at $40 over the next 5 years, we have a challenge.
Ted, I don't know if you want to jump in.
Yeah, I mean, I think, look, I think Christian's analysis is probably accurate, although the one thing I would point out is LPG exists, and you can see it in 2014 and 2015. We certainly benefited from a tight shipping market, but the relative prices of the commodities were absolutely where we wanted them to be. You know, Christian pointed out that 50% of global demand is from heating and cooking. That grows with GDP and population growth. It shrinks with you know, natural gas penetration. But we've seen pretty steady growth because in a lot of the emerging markets, that's not a countervailing factor. Of the petchem piece, they're the most price sensitive, and that's about 25% of the 50% that's non-residential commercial. And so what those guys do, the purchasing managers of those companies, are looking at the bid away. And so if when LPG is cheap relative to naphtha, and that's usually less than 90% the cost, they will start thinking about switching. Right now, U.S. LPG versus Far Eastern naphtha is like at 86%, so it's not really where we want to see it. If you look back a couple years, it was 50% and less. That was an absolutely wonderful environment for our business because the guys couldn't get enough LPG. So while I think ultimately the fixed costs of drilling in the U.S., which are still relatively low, do provide a floor on the oil price that we'd need. Theoretically, it doesn't matter what the oil price is as long as it's cheap, as long as LPG can be cheap enough relative to LPG. But I suspect again that it's tough to cover your fixed costs as a driller at $30 a barrel. But nonetheless, if you could, and there are guys who can, if LPG's trading in the right ratio, we can still make money.
Okay, that certainly makes sense. Miguel, maybe a question for you. Just wanted to get a sense from end markets, so destination markets for LPG. We talk a lot about India. We talk a lot about China. Are there other markets we should be focused on where we could see sort of opening up over the course of the next couple of years?
Well, LPG as such for ship owners is a vast market. You have various different types of ships. You have the pressurized ships, you have the semi-ref ships, you have the fully ref ships. Ranging from 3,000 cubic meters to 86,000 cubic meters. You have also the ethylene carriers that are also in that category of LPG ships, and all of them have various and very different trading patterns. I think EXMAR is one of the few companies in the world that has all those type of vessels within its fleet, managed and owned. We see that on the VLGC market, they are definitely being there for the long-haul trade, from the Gulf to Asia, from the US to Europe. And they make a lot of economical sense to do that trade. When you look at the smaller size, the pressurized market, it's of course there for coastal trades. We have 10 in our fleets right now. And we see that they barely move from their geographical positions, apart from going from one port to the other, but within a range of 5 days sailing maximum. The mid-size segment, in which EXMAR is quite strong, is a little different because they can do coastal trading as well as long-haul trading. The mid-size vessels are capable of transporting not only propane and butane, but also ammonia. And this is in the ammonia sector that we do long-haul ranges with those vessels. And so we trade from Russia to the US for the fertilizers industry, which should be typically done on a VLGC. But VLGCs are not made to transport ammonia. So there are plenty of upcoming markets for the entire LPG space. But when you think about LPG, you have to also think about ethylene and ammonia. And most of those markets are covered. We never see on a panel like this any South American LPG company. But there are some that are out there, and they keep trading around Chile and Argentina. We barely see them, and we like them very much when we need to sell older tonnage, because they're always paying a good price for older tonnage that probably the Statoil and the Shell of this world would not accept anymore. But we see that market definitely expanding. Currently, we have vessels trading all around the globe, from Australia to the northern US. And I don't think there is an upcoming market, although we see that there is a big push from India and from China to import much more LPG in the future.
Yeah, does that make sense from your perspective?
Yeah, absolutely. I think, in terms of emerging markets in the VLGC sector, we benefit from, all sorts of pull-throughs. So we continue to see growth in Pakistan, Vietnam. Indonesia has been sort of the poster child for LPG adoption. In 2005, there was very little LPG imported into Indonesia. They had a lot of environmental issues with air quality. And they, if the government mandated a switch away from kerosene and biomass, and we've seen it now become a major LPG importer. But generally, there's a lot of pockets of demand in different parts of the world, and it depends on. There are only about 110 VLGC capable ports in the world, so in some level we're a bit limited in terms of our market, but it's a pretty darn big market and keeps 200 ships busy pretty much all the time. But we do see, I just wanted to add one small point. VLGCs can ship ammonia, we just don't choose to. It's pretty corrosive on the tanks.
Fair enough, that's helpful. So Ted, picking up on what you mentioned, which is essentially, pretty decent utilization, rates are maybe not quite as decent. Christian, maybe you can talk a little bit about sort of the ability of the global fleet to continue to absorb capacity, keep utilization high. How do we think about utilization trends for the vessels as we move forward?
I have to admit that it's a bit challenging to be optimistic in the next year. What has happened in 2016 is a very, very strange and odd situation. The global VLGC fleet has a utilization above 90%. According to all shipping theory, such utilization will give high freight rates, because when we fix a ship, we don't really care if our customer make money or lose money. We hope he makes money, but for us, it's really supply and demand of ships. So we price freight based on supply and demand of ships. And with the high fleet utilization we've seen this year, we have 92% year to date. You would believe that the freight should be much higher. There are another 10 ships being delivered this year. There are 24 more ships coming to the market next year. There is, except for the P66 terminal, which Ted mentioned, there are hardly any new demand for shipping coming over the next year and a half. So with the very, very difficult freight market we have today, we think that 17 might be a big challenge as well. And we think it's difficult for the freight market to turn prior to the spring market of 18. The good news is, of course, that after delivery of the last ship in 17, there are only 7 more ships on order. And with the current freight market, I don't expect to see any more orders over the next couple of years. So we are optimistic. We are a bit pessimistic for the short picture. Having said that, this is about marginal tons. And there are, as I just mentioned, there are no more bottleneck in the U.S. terminals. So the U.S. terminals can increase their export. We do expect a couple of more cargoes from LNG production in West Africa. So a couple of more cargoes per month, 5-6 cargoes from the US, a couple of cargoes from West Africa, and the market will turn very quickly. So there is hope, but realistically, I think 17 will be difficult.
I've seldom been accused of being an optimist, and especially with CEOs who live and die, love freight and everything else. Christian's, of course, has a lot of totally accurate points. The one point that I think is worth mentioning from a global fleet perspective, 20 years of age is a bit of a magic number in our business. The oil majors really won't touch anything older than 20 years of age. They don't have to. We're both in the fortunate position that all of our vessels are substantially younger than 20 years of age. There are a number of vessels already aging out, and as you move from the 20, in the 20 to 25 year range, it limits your addressable market fairly significantly. And when you move beyond 25 years, it's a very small market. So we've got aging coming on in addition. With the IMO adoption of ballast water treatment system directive, people have got to start putting in ballast water treatment systems starting next year with dry dockings beginning, I think, for September 17. And so that's going to force some really hard economic thinking on owners of older tonnage because look, they're not that expensive to put in when you have a new build. It's a bit more of an undertaking, depending on which system you use, if you decide to do it in a dry dock. And so that should provide us some freight market relief in terms of vessels on the water. But on the other hand, there are challenges ahead. But that is one small glimmer of light that I do think is worth mentioning.
That's helpful. We always like an optimist in this business, that's for sure.
Wow, I'm an optimist. That's scary.
That's scary.
Miguel, I said before I'd only ask you the easiest questions of when the market will turn and by how much. So maybe if you want to weigh in on sort of the trends and how you think the market might develop over the course of the year. What Christian and Ted sort of making sense to you? How do you think about that?
Well, the market already turned, but in the wrong direction.
Fair point.
No, indeed. I think Christian comments was making a lot of sense. We are operating in a supply-driven market. There is not so much additional supply coming in the coming 2 years or 18 months to the market, and there are way too many ships. The problem with the shipping companies, when they go bankrupt, the ships are still sailing. And there are way too many shipyards. So we have to behave together and brace for the storm. It's going to be a stormy weather out there for the next 2 years, definitely in the LPG trading. This is why at EXMAR we definitely choose the strategy of trying to fix as much as we could in the last 2 years for the longer term possible, and we have about 85% of our fleet covered for the next 12 months. So we are creating some buffer in this sector and definitely not going for the spot exposure right now. But it will also create some opportunities for companies like ours to join forces and try to create something bigger, something more pure players in the LPG space. But definitely in the next 24 months, it's going to be challenging. Although we have seen that since 2003, as a diversified LPG owner and operator, we have actually never really lost money on the overall fleet. There was still a part of the fleet that is kind of much more than break-even than the minority of the fleet.
That's helpful. When you think about just specifically around some of the vessels that are delivering, so I think we have 34 vessels delivering by the end of 2017. I don't know, Ted, if you want to comment, do all of those vessels hit the water? Do they all hit the water before the end of 2017? How do you think about the development of the order book, just given what we're seeing in terms of supply-demand in the business?
My view is that historically we've seen very few, if any, cancellations or slippage. Part of the reason is there's so much componentry that goes into a VLGC carrier. There's two guys in the world who make the heating plants. They both rely on the same Swiss company to make the compressors. So there's fairly long lead time, and so as a result, the cancellation costs would end up being pretty significant. And the one time, again, it was a different market environment, but we did see one player default, and BW jumped right into their shoes. So I tend to believe there could be some delays potentially if people can do some clever things with the yards to delay the arrival of ships. But I would expect, at least in our internal planning, we assume they're all going to come. And if they don't, some of them don't come, well, that's gravy.
Okay. Yeah, no, that certainly makes sense. Christian, I wanted to ask a sort of specific question about sort of the trade and the Panama Canal and how that might impact the business. It feels like it has the potential to maybe take some miles out of some of the trades, particularly U.S. Gulf outbound. Is that the right way to think about it? Is it sort of a temporary in nature? I mean, how is the Panama Canal being utilized, and will it be utilized as we move forward?
It certainly has capacity to take away ton miles. What we have seen is that there are very few ships going through Panama, so it's hardly being used. Part of that is of course, at the current low freight rates, it's actually more cost-effective to go via Cape than to do Panama. I think in a strong freight market, which I hope we will see soon, it's likely that the Panama will be utilized more than it is today. So yes, In our fleet utilization models, we assume that 50% of the US export will go via Panama in the laden leg.
Okay, that's helpful. So sticking with you, Christian, let's talk a little bit about fleet strategy. So we kind of have the outlook of the market. It's maybe not all that optimistic for the next period of time here through next year. How do we think about deploying the assets effectively? How do you just sort of continue to try to make some money in a tough environment?
I think Avance Gas is a 100% spot player, and our strategy has been to pay out all earnings in dividend. We changed that early this year when we were a bit suspicious about the market going forward. We went down to 50%, and for second quarter this year we ceased the dividend payments as we didn't make money. So to be able to trade in the spot market as we do, you need a strong balance sheet. So we believe that we have a very strong balance sheet. We have a very clean lender structure. We have 2 facilities with up to 8 major shipping banks among them. We have by end of second quarter about $100 million liquidity. So we continue to trade spot. We do, as I said, if we get the marginal cargoes, the marginal tons, the market will turn, and we'd rather like to be there and take the opportunity of the market instead of locking in the terrible low freight rates we have today.
What would you need to see to reinstate the dividend?
We need to we need to make money again.
It's a good thing to look for. Ted, let's talk a little bit about the fleet strategy as well. How do you think about sort of navigating the next 18 months or so?
Very carefully. We've got a bit more. We have several ships on time charter, and we took a lot of grief for that at the time. We're happy we did it. It's worked. It served us well in this environment. We operate through a pool, and so we figure that we believe that's helped us quite a bit. And I think to Christian's point, look, you hate to say it, but shipping is a commodity business, and you're ultimately a price taker. So there are different things that all smart ship owners do to manage exposure. I mean, look, first of all, with technology being what it is, I think as an industry we're much better able to balance the global fleet as players. You're able to more quickly see, okay, there's going to be too many ships in the west. I'm not going to go back west. I'm going to ballast back east. That helps, but also there are various cost levers that anybody can pull. It's never fun, but if that's something that needs to be done, and smart ship owners figure out ways to do that, and so if that's what's necessary, everybody's going to figure out a way to kind of make money, continue to take care of the trade, and work together with all the various stakeholders to make it a success.
That's great. Want to make sure we have an opportunity to get the audience involved here, though. But I do want to pick up a little bit on something that Miguel had said before. So you had mentioned that the fleet is 85% covered. So I'm not going to ask you that necessarily that question. But M&A in the space, I mean, is there opportunity for consolidation? For years covering the shipping industry across all of the subsectors, there's always been discussion of mergers, but not really much action in that respect. So how do you think about that? Is that really an opportunity? Is it something that we might see?
Well, I think in the LPG there's been a very business-minded summer, definitely in terms of M&A activities. We at EXMAR, we acquired our joint venture partners, Huaquang, out of 10 vessels earlier in July. We see some interesting moves on Aurora or around Aurora LPG, which is a listed company owned predominantly by BW Gas out of Singapore. And we see other players as well looking at some consolidations by means of stock, cash, or maybe vessel swaps. We are in active discussions with some of our friendly competitors in terms of trying to have a piece of their fleet that can interest us. Of course, not every single fleet in the world is interesting or complementary to our fleet. So we are careful in picking and choosing the right ones. Was this summer maybe too early to already go into a consolidation mood? Time will tell. We believe that at least the prices we pay for the Wakong shares in the 10 vessels, which are smaller size, was definitely a very attractive price for us, and that they should be profitable in the near future. We will definitely seek other opportunities like this ones in the coming months, and for sure BW Gas is going to make an offer on Aurora LPG at some point within this year.
That's helpful. I know we want to make sure we get the audience involved, so I think there's a microphone, so if you have any questions, please feel free to raise your hand.
There's one here.
Ted, you mentioned biomass at one point, or biofuels. Given the fact that those are a lot easier, be it biomass as wood pellets or biofuels, which can go in any old chemical carrier, as opposed to the complexity of LPG carriers, add that with the various environmental restrictions, do you see any encroachment of renewable energy on the LPG trade, especially when you get down to residential use or small-scale commercial use?
Look, I think one of LPG's biggest benefits is the relatively modest cost of the shoreside infrastructure. You can't beat, most of the biomass that's getting burned in the emerging markets is people going out into the forest, cutting stuff down and burning it, burning trash, that sort of thing. And that's really what the governments are understandably focused on, getting folks away from. Solar and, wind and all that stuff's wonderful, but you're talking about billions of dollars of shoreside infrastructure to get the last mile. The great thing about, the great thing for our business is a canistering plant just isn't that expensive. You get the gas, you put it in the back of a pickup truck in one of those canisters, and the customer's taken care of. So never say never, but at this point, it's not something that keeps me up at night.
Okay, we have time for one more question.
Okay, great. Well, gentlemen, thanks very much for joining us. We appreciate it.
Thanks, Christian.
Thank you.